Welcome back to the Smart Investor Show. Today, we're joined by John Micalizzi, a finance broker with Blue Lantern Financial Services. John is a lending specialist with over 25 years of commercial experience spanning accounting, insurance, and finance. 9 years ago, John decided to start his own finance broking business to provide personalised service to help clients navigate the complexities of finance and funding solutions to meet their property and investment goals. John is a trusted advisor to both clients and business partners, providing guidance on structuring loans and optimising financial outcomes. Beyond the world of finance, John is also a passionate leader in sports, serving as a coaching director for the University of New South Wales Football Club. His ability to mentor and guide others, whether in finance or on the field, sets him apart as a dedicated professional committed to helping others succeed. John Micalizzi, welcome to the Smart Investor Podcast.
Thank you, Jordan. Thank you for having me. Really appreciate it.
Great to have you on and appreciate your time. So, mate, it'd be great to start with, we're going to dig into the land of finance and talk a little bit about your story, about your business as well. It'd be good just to get a little bit back at the background of the John Micalizzi story and tell me a little bit more about you as a person, childhood, growing through, and what's got you to where you are today.
Well, yeah, let's start at the beginning. So my childhood is probably no different to one of the many migrant stories, around Australia, first generation Australian, hardworking family. I followed the traditional path of school, after school sport, university, career. So no different there. My enduring memory of my childhood is food and family gatherings, just to and personality into that. So when it came to career, I did a high level of maths at school. So my career followed the numbers essentially. So I always had roles in either finance, accounting, or insurance, and they were predominantly sales and marketing roles. So what then happened was, to get into this point, was I combined my sales and marketing experience and the learnings around client service with my technical and professional background around finance and accounting and insurance, and decided 9 years ago to start a broking business. And here I am today.
I assume a lot of that big family, John, as well, coming through?
Yeah, so that was the immediate family. But yeah, the extended family was quite large. Cousins everywhere, Australia, Italy. So it was quite large. Yeah, family gathering could be 35 to 40 people.
I was just about to say that. I said, I think the migrant story, regardless of where we come from, is always those big gatherings. And that's what I remember in my child, just, the house, whether it's our house or other people's house, just full of people. And food was always the center of attention.
And it's funny, there was always food left over. So yeah, it was amazing.
No, excellent. And so university, you said then you went and worked in the corporate world to grind your knowledge and your teeth and your process. That was probably a good experience for you to get you where you are today.
Absolutely. So what you get from working in corporates is you get all the training, you get all the technical skills that you need, or that I need to do the role the way I do it now. You meet good people, you get good life experience. And also then, as you go through your career and you get pay rises and you start to think of the future, then I started, investing in property as well.
Great. Well, that's a good segue actually, John. Being a property show, it'd be great to get a little bit of insight into your property journey.
Yeah. So it started out like many, in an acquisition phase. So buying investment properties to generate wealth, create wealth, did some renovating and flipping as well. And then through to a consolidation phase where effectively getting me to the point where I am now, my financial position where I am now. And now it's altered slightly in that the focus is more, looking at property from an investment and income perspective, planning for retirement.
No, excellent. And those, have you held on to properties, John, or you mentioned flipping as well? So sometimes you've bought and sold along the journey.
Bought and sold. So apart from my home, there's not one property that I've held for the whole entire journey. That's a simple case of, in some instances there was a requirement to sell because of what I was doing at that point in time, or that particular property I felt had run its race and it was a good time to cash out. So no, I'm holding property at the moment, but there's no property that I've held for the whole journey.
Well, that experience, no doubt, helps a lot in your business as a mortgage broker and an expert around building structures and financing your clients' needs. Have you delved into the commercial side at all, John?
Not in commercial property, no. I believe commercial property is very specialized, and I think it's also, if you haven't got someone like yourself helping you or experts around you, and you haven't got deep experience, it can be quite risky, right? So therefore, I've stuck to residential. I've funded commercial property. I do commercial finance. I started a commercial finance business myself, where I had to get funding and then, facilitate that to others. So I have experience on the finance side. I've just chosen myself not to invest directly into commercial property, on the assumption that I've probably got exposure to it by, my super fund. I have bought shares in, various property trusts in the past.
Yeah.
But yeah, I stick to residential because it's less risk and it's what I know, and I've got deep experience in it.
Yeah, no, it makes a lot of sense. And it is, we often get a lot of people asking about that. And I had someone the other day that we've just bought their second investment property in the last year, so quite quickly. And he came back and said, I'd like to get into commercial. And when you drill down a little bit further and talk to him about the why, there was no real solid reason. It was just that, someone at a barbecue mentioned commercial property, but when we went through the pros and cons and financing requirements, he decided to just didn't have that risk profile for commercial, because it is a different, like you said, a different mindset and a different beast. So we do see people a bit later in their journey do get into commercial, but in that early piece, especially property 1 to 3 or so, it's normally the residential side.
Yeah, it's a really interesting point you make. I mean, I get it as well. I get people who have had the barbecue chat and someone has just told them the headline numbers. Say, oh, the yield on, commercial property is 9%. And so what my finance background taught me is that yields are high for a reason, because there's risk. The question I play back to people is, do you understand why it's 9%? And more often than not, the answer is no. I said, well, that's the key thing you need to understand. It's a high yield because it's high risk. Commercial property, as a general rule, you get that high yield and you can get longer term leases, which is good. The issue becomes, if the property is empty, it can really burn a hole in your pocket because they can stay empty for a long time.
Yeah, exactly right. And that's where, like you said, weighing up the risk tolerance and appetite of the individual investor. Speaking of yield and risk, I mean, do you hear much about, or do you get many clients coming to you to talk about NDIS, which is something, again, great barbecue talk, great numbers on the surface, but the risk profile is very high for that type of product. Do you get much of that coming through to you?
Yeah, I did. And I did look at it, and I decided not to play directly in that market. If someone's got enough equity in their home or other property and they want to do an equity draw or a cash out to then fund an NDIS purchase, okay, that's fine. I'll help them with that. But I've decided not to get directly involved where the NDIS property is the security. My understanding is they don't necessarily value well. And one of the reasons is that sometimes they're built in areas where it's all NDIS properties, and then resale is very difficult because, well, who do you sell it to? You have to sell it to someone else who's interested in NDIS. So yeah, it's specialized lending, a specialized property, which I try and stay away from.
Yeah, we've done the same from our advice side. haven't gone down that path for all those reasons and more. And it's an understanding game. It's also linked to the government. I always believe there's some element of risk to that. And we've one good thing about being around for a little while, John, for us is that we've seen a lot of these schemes come and go. And we've seen a lot of people potentially not do so well or being burnt through these schemes. And one of those numbers I heard recently, I think there's over 1,000 NDIS providers in the country. And every time we see an opportunity, or I won't say a loophole, but maybe a strong opportunity for quick gain, we see a lot of people enter markets. And we can talk about pink bats, we can talk about solar panels and all sorts of different industries like that pop up overnight and then disappear quite quickly. And I believe we're seeing the same in NDIS.
You bring up a really excellent point, and that is anything where it's government backed or there's legislation that underpins it. You need to understand that government can change or legislation can change, and it can, in as simple a stroke of a pen in Canberra or wherever, that can then change things dramatically and forever, right? And so it's again, it comes back to that risk reward equation. Yeah, it's a higher yield because there's higher risk.
We've actually just seen that just hit the anniversary, John, of the NRAS scheme, if you remember that one.
Yes.
And we've just hit the 10-year threshold of that. And now the government's actually out there buying these back and they're going to turn them into affordable housing. So it's really interesting that, there was that 10-year horizon where you got two-part payments from the two separate government bodies, federal and state, and then now the 10 years is over and now they're buying these back because a lot of them, definitely, most of them are built in, like you said, areas where they've built a lot of them, don't really increase in value because they're, rented out to a socio-demographic that doesn't allow rent to go up and things like that. And a lot of these were pegged by the government on the rental side as well. So, that's a good example of something 10 years later that we can look at today and analyse the success or they're not of the program.
The other good barometer here is, coming back to the finance world, is if the major banks won't fund them or won't take them as security, that's a good barometer as to they believe there's some inherent risk in fundamentals of that property asset class, right? So regardless of what you think of the major banks, there's a lot of analysis. They've got a lot of data. They've got a lot of intelligent people who analyze these things. And if they don't want to fund it, well, that tells you something.
Yep, definitely a good barometer. The Smart Property Show is proudly brought to you by Search Party Property, nominated by REB as Australia's best buyer's agency and buyer's agent for 2025. Looking for your dream family home, a prime commercial property, or a smart investment? We've got you covered. Unlike others, we don't rely on selling agents or property managers. We have boots on the ground in key investment cities across Australia. Powered by data-driven insights, we give you the edge to secure the best deals. Ready to invest smarter and grow faster? Contact Search Party Property today for a complimentary discovery call. So, John, let's get into the knitting, so to speak. Let's get into the market and finance and what you're seeing every day in the market. It'd be good to just get your views initially on, have you seen any changes in either demand or lending or anything outside of that since that we had the little interest rate relief almost a month ago now?
Yeah, it's interesting that there has been an uptick in activity. People seem to be waiting for the rate cut, which is more around human behavior than any real fundamentals as to why you should wait. Some people waited because, they think that it's going to give them the uptick in borrowing capacity that they need for a purchase. The reality is, on a $600,000 loan, the uptick in borrowing capacity on an owner-occupier basis is around $10,000 to $15,000. So it's a little bit, but it's not that much. The other thing it does is it's spurred more demand, which then can put prices up. So any increase in borrowing capacity may be frittered away with increase in prices. So I heard one client share with me, and again, this is what they're telling me. I don't analyze the numbers. It could be incorrect, but they said by waiting 4 months, on their investment property decision, it cost them $10,000 a month in that by the time they bought something versus if they'd acted 4 months ago pre-rate cut, the difference is $40,000.
And that's 100% believable, depending on what market, where they were buying and the price point. Definitely. I mean, we saw that, especially when you get those bull markets, John. And we've been doing this for quite a while to see those markets. In Brisbane after COVID, we saw it in Perth from sort of 2021 onwards when we started buying there, particularly in 22 and 3 when it really heated up. And people, if you did sit out for a month or two, you were losing 10 grand a month easily with the fast growth in some of these bull markets. And then if you're buying in that sort of, these are cheaper or more affordable properties. And if you start talking about, let's say, Sydney, when you're talking $3-4 million, then that's very believable.
Yeah. The other side here is refinances. So again, there's been an uptick in refinances. And again, I think it's more, so my clients, I educate them along the process, but then I talk to potential new clients and they've waited for the rate cut to do refinance. And what I've had to educate them on is they didn't have to wait because it's all relative. So if you would have refinanced to get a cheaper rate, now it would be even cheaper with the rate cut because it's all passed on, right, on a variable rate basis. So I think both what we do, more so probably yourself, is intrinsically linked with human behavior and rationale.
100%. And, we see it every day. And it's part of the enjoyment, to be honest, of both our jobs that we probably the frustrating part is a lot of people are taking advice from the barbecue chatter and their friends at the barbecue are their experts. And that's where they make their decisions, which is dangerous, but that's, again, human nature. So it's always, really enjoyable for me. I take great joy on having to chat to someone about some of the items you just mentioned. And, someone today talked about, I might just wait for another rate cut. And it's like, well, that could put you further back. I might start to save some more money, things like that. I heard Melbourne's in a real big bad way and should never invest in Melbourne. It's in fact the opposite right now, where we've been in Melbourne now for 6 or 8 months. We want to get there while it was in the dip of the market. And now we're getting auctions where there's people queuing up to get open homes and things like that. So that's not being reported yet, but it will be. And once that FOMO kicks in, the same thing will happen there, like what we saw in Perth and Brisbane before that, and Adelaide as well.
Yeah, it's really interesting. We started talking about my property journey, and I can assure you this, that when I look back, it doesn't really matter about the actual rate per se. What I should have done was, when I had the borrowing capacity, act, right? And where I didn't act, there was an opportunity cost loss. Yeah, it's all about borrowing capacity and understanding, having buffers, having a level of comfort. The rate per se is almost irrelevant.
No, agreed. I mean, we often talk about, terms like, firstly, about taking action. Like, that's the most important step. You've got to take action. And that's the only way we're going to, build wealth for the future. And also, we often say property investing is a game of finance. It's not about the property side, it's a game of finance. And that's why we talk about building a team of experts like you, who are property savvy mortgage brokers, to help our clients get on the right track and build the right structures, use the right banks, and for depending on what their strategies are for their long-term property investing goals.
Yeah, agreed.
So, mate, one of the trends that we've seen sort of last year, and again, it's only still relatively early in the year, is SMSF buying through the SMSF funds. What sort of insights can you tell us around SMSF borrowing, and what are you seeing in the market around SMSF lending?
Yeah, so that trend makes sense to me, and for a few reasons. So one is, firstly, people have decided to take control of their superannuation and start self-managed super funds, which, aligns with the trend of, DIY, do it yourself, take control, etc. More sophistication, more guidance and advice. So that makes sense. So from there, when you look at the fundamentals around short property housing supply, tight rental markets, then people made the decision, well, that's an asset class that I want to invest in via my super. So if you put all those fundamentals together, it makes sense. It makes sense. Right? So what people need to understand is that, and coming back to the barbecue chat and the questions that I get, question that I often get around super is people just start with, I've heard you can buy property using your super. And I have to just slow them down. I go, that's not quite correct. You have to start a self-managed super fund and then put the structures in place to then be able to buy a property via super. And they go, oh, how do I do that? And I said, well, that's not my level of expertise. You need to talk to your accountant. You need to talk to a financial advisor, right? So that's the key thing that people, need to understand, and they need to have an appetite for it. The other understandings that people need is that not all properties can be funded by super. So, for example, as a simple example, an owner-occupied property can't be funded by super. Okay, has to be investment property. Okay, the better rates and fees are when you put a 30% deposit in. So traditional super lending requires a 30% deposit. Okay, I mean, that's key to understand. It's a restricted market, meaning that not all lenders play in this space. So therefore, and because it's specialized lending, there is higher rates and fees. And then with that, there is more documentation, right? So it's not, people need to understand that it's not your standard residential lending. Okay. The last point I'd make is that if, for those who have already been in the bullet and are in the property market by the super fund, they should check their rate, because some lenders have exited the market, but they still have clients. And so they've put their rates up to try and get people to refinance. And some people think you can't refinance in the self-managed super fund. You can, you just have to understand the costs and how you'll account for the costs.
Yeah, no, there's a lot to take in there, and it's a lot of red tape around that too, right? Building the fund out with audits. I had someone the other day, so they got their fund set up 3 years ago, and they haven't moved their money across yet. So they're paying for audits. The ATO, which is it's held them back at the moment. We'd have to wait for them to transfer the money across. But the ATO actually asked them questions around why this was done, why there was no money, where's the money gone, things like that. So they just thought, we'll get it done. And then life got busy. They built a house and got busy with their corporate jobs, and they left it there empty for 3 years. And now ATO are asking them questions. So it's an interesting about going back to taking action, actually understanding what it takes to set this up and actually doing something with it.
By doing that, they've actually duplicated their fees. So they would still have fees in whatever super fund that their money is still in, and now they've got the fees of their self-managed super fund. So they're actually duplicating fees, and it's sometimes that happens because it's sort of out of sight, out of mind. You think, oh yeah, well that they don't see it in their general day-to-day family budget, but what people need to understand is that that's money that is getting frittered away that should be there for their retirement.
Yeah, and every year they're going to get an audit paper that they've got to get done, and their tax agent will send them something to put that together. But like you said, sometimes if it's just, we'll do it next year, and 3 years down the track, now they're ready to go. But there's still a while to go. I said, you need to get these 3 things done before we can even start talking about property. So building that team of experts, I'm always reminded of that every day with clients and prospects to get that done. And John, it's interesting around the SMSF side, and I think that was very helpful for a lot of our listeners around how to get prepared and what they need to look forward to. What about in the general lending landscape? What do you have? Has there been any change in the appetite from your major banks that you're working with? I mean, I know you've got a big panel, and it's just anything significant that you're seeing since this rate drop?
Access to lending, I don't think has really ever been better. Lenders, they're open for business. Most of them have got electronic processes, which makes things relatively easy these days. Around self-employed, a lot of lenders are really opening up there, and rather than relying on 2 years of financials, they just rely on 1 year financials. Lenders are requiring less pay slips, less statements, because there's a lot of data there, which means that they don't need full documentation sometimes. So access to lenders, has never been better. There's always lenders who have got really sharp rates because they're trying to attract business. The only thing is that at the moment, there's some lenders with the rate cut, and then with things like Cyclone Alfred, and they've probably cut their rates. They're too competitive. Their turnaround times have blown out, right? So access to lending, in my opinion, has never been better. You hear people saying, oh, banks are really tight or banks are tightening up. Banks, apart from COVID, where they tightened up for a little while because that was obviously they were worried about people's full-time employment prospects. Bank policy hasn't really changed, in the 9 years, dramatically in the 9 years that I've started. What you hear is there will always be people who can't get finance or can't get the answer that they want, i.e., they want to borrow $1 million, but the bank is only willing to lend them 800,000.
So I'm about to say, just on that, someone said to me the other day, it was easier for you older guys to build property portfolios because you just can't get money anymore. That was the statement that this person said to me. And I had to have a bit of a chuckle about that because, again, it's, creating his own fallacy and his own thoughts around what's happening in the marketplace, which is, you just said, isn't true and what you're seeing in the market.
Yeah. So, look, there'll always be people who can't get finance or can't get the answer that they want. And all that is, it's a case of the numbers, and it's a case of our well-intentioned credit laws, which are designed so that people don't overextend themselves, right? And that's all it is. It's for consumer protection. And that's why we do have a strong property market. And that's why we don't have situations like in other countries where there's mass foreclosures. It's because the fundamentals around the lending means that it's done very sensibly and conservatively. We've just gone through a period of 13 rate rises over a short period of time. Yeah, there was some mortgage stress. Yeah, I'm sure some people, unfortunately, may have had to sell or foreclose. But there wasn't this bloodbath that the media predicted. Right, and that's
what was
because
that word? 2 words, John? Was it mortgage cliff, wasn't it? The one that bandied around at the front of the headlines for such a long time, and no one, that cliff never really arrived, did it?
No, and it's because we have these strong principles around lending, right? So that's the positive side of it. Again, on the other side, it means that some people don't get credit or can't get the answer they want. And again, it's for their protection, because what it means is that the numbers or whatever in their scenario, there's something that says either you shouldn't be lent money or you shouldn't be lent the amount of money that you think you want.
That's right. And we've been around, again, like you said, we saw what the lending environment was pre the Royal Commission, and those new legislations, laws put in place are for good reason, because of what was happening with, unfortunately, a few unscrupulous lenders and brokers out in the marketplace.
Well, interesting there. So with everything around the Royal Commission and, trying to get the compliance right for brokers, it's actually turned into a great benefit for consumers and clients, in that when you deal with a broker, we're actually held to a higher standard than the banks, because we have to provide 3 options to you. Whereas if you walk into any bank or go to a lender direct, they have no obligation to let you know what's happening in the market. All they have to do is explain their own product. They don't have to explain if their product is 0.05% more than bank down the road. They have no obligation to do that. Whereas our obligation is to comply with best interest duty and give you 3 options.
Well, it makes sense why we keep seeing, what's the rate now, John? Is it over 70%, close to 80%?
70% of all loans are introduced by brokers in Australia.
There you go. And I think what you just said there, that statement there makes sense why, right? And why that continues to grow.
Yeah.
Well, excellent, John. That's been really insightful. I'm sure our listeners will get a lot of insights from that and continue on their journey on how to build and get prepared and ready to take action in property investing. On ending, what do you see in the market, John, from a property investment point of view? Are you seeing some good times ahead? Are you seeing some rocky waters? I'm not asking you to make any big predictions to get on the clickbait headlines, but what are you sort of seeing in the next 12 months or so?
Yeah, I'll leave the bold predictions to experts like yourself. I just fund the properties. I don't, play in the property space, if that makes sense. And there's an important distinction, right? We're joking, but we're not. And I think it's an important distinction that people have to make. And that is, I do finance, and that underpins, the property, and they're separate. So no bold predictions. The lame prediction I'll give you, if I can call it that, amongst friends, is I just can't see property prices going down dramatically overall. I just can't see what would cause that to happen. So with the tight housing supply, which I know is true because my clients experience it, tight rental markets, I just can't see how property prices will come down in any significant way on an overall basis. Yeah, there might be some areas that may be bad because of oversupply or something else. But as I said, overall, the headline numbers, I just can't see how property prices will come down.
Yeah, no, and I think history shows that as well. And all markets have different times. I often show a 40-year graph, which shows that, Sydney has, a great 8 years or so, and then it might have a balance, a consolidation period for the next 6 years. And that's happened over 40 years of history. And that continually shows through every capital city in Australia that, why we talk about diversification in property markets and also, getting into the property market and having patience like you've done with your property portfolio over many years.
And this is really important for people to understand. It's as I said, I keep going back to don't necessarily worry about the actual rate. The focus should be on is the phase we're in. So my sense of the phase we're in is rates are steady and may come down. Okay. So the bit about being steady should guide people's decisions. Right. And then from that, look for cues. Right. So if interest rates do come down, understand why they have come down. Well, they can come down for one reason, really, and that is predominantly if they're coming down dramatically, it's because there must be something bad that's happening in the economy where the government thinks we have to cut rates to stimulate, demand again, right? And so then from that, understand what phase we're in and then act accordingly, right? And understand, okay, if that's the phase we're in, if rates are steady and may come down, make your decisions, accordingly, and then apply that to, your own scenario, to understand if you can act and how you should act, and also what buffers or contingencies you need to put in place depending on, what people think of the phase we're in with regards to rates.
That's great. Wise words, John. And I know our listeners would have got a lot out of our discussion last half an hour or so. So thank you again for joining us today on the Property Investor Show, and look forward to catching up with you again soon.
Thanks, Julian. Really appreciate it. Thank you for the opportunity. And likewise, I hope the audience got something out of our discussion.
Sure they did, John. Thanks very much. Bye for now. Thanks again for joining us on the Smart Investor Show, John. And of course, thanks to you for tuning in. I hope you got something valuable from this episode. If you enjoyed the show, it'd mean a lot if you could take a moment to rate and review it on your favourite podcast platform. It really helps us reach more listeners like you. And don't forget to hit subscribe so you never miss an episode. Thanks again, and I'll catch you next time.